Ben ritrovati, un'altra giornata sul floor del New York Stock Exchange. Siamo tornati all'assegno meno per l'indice di borsa, interrotto il rally. Ne parliamo con la mia ospite qui con me sul floor, che è Doreen Mogavero, che è fondatrice, presidente e amministratore delegato della Mogavero Lee Co. Doreen, thank you so much for being with us again.
Oh, thank you. I appreciate it.
So Doreen, today we are back down, and it seems like the rally has been interrupted again. So the optimism for the economy is not enough to counterbalance the worries about Europe.
Well, I think you're still looking at very light volumes, and it's still very early in the year. I don't think much has really changed from a week ago in the world or in the regulatory environment or in any place else or the U.S. economy, enough to think that the volatility that we saw last year will not continue this year. I think it will continue, and I think it's going to continue for quite a while. I think that the overriding U.S. data would be more significant if people had this feeling of confidence, which seems to be lacking in the markets and in our government in general. Because I think the U.S. data is improving. I don't think it's great, but I think it's improving. And the stock market, as you know, is about a year to a year and a half ahead of any real recovery. So it's a predictor. So people are making a bet that in a year and a half, I could see the economy being much better. But I think the wild card remains, the European situation. And I think with Greece talking about default in March, I think that puts a whole other set of problems in front of us. If they begin to have actual defaults, well, then I'm not quite sure that the economy here is strong enough to supersede anything that goes on in Europe. So I think that we're going to have to just keep watching this sort of up and down for a while.
And tomorrow it could be another one of those days of up and downs. As you were saying, economic data. Tomorrow we have the big numbers about unemployment. We are expecting some numbers to go up in terms of non-farm payroll, but we are seeing the unemployment rate going a little bit up. 8.7%. Do you think it really reflects what's the actual situation in this country at the moment?
No, I don't think it's even remotely close to what the real situation is. I think probably if you really want to look at the definition of unemployment, unemployment is loss of income. And I think if you really want to look at the people that have lost income, you're probably, I've heard statistics anywhere from 16 to 18% as a real number in terms of people that have fallen off the rolls and can't be tracked anymore, students that can't get jobs, elderly people that have lost income in their retirement accounts or whatever it might be. So if you look at the unemployment figure in terms of loss of income and not just in trackable working people, I think you'd find that it's significantly higher. I think everyone agrees on that. So I'm not so sure if it's 8.6, 8.7 or 8.8 or even 9%, if it really makes that much of a difference. My pediatrician always tells me you have to see how the child looks and how he feels and how he acts to really tell how he is. Doesn't matter if he has a fever or anything else. It's how is he acting. And I know when I look around me, people are still acting very nervously, and they're still acting as though they have economic issues. And I think what's also significant is you've seen a rise in credit card use and applications, which I think is... Well, I think that is another signal. I think that was a holiday phenomenon, and hopefully people will remember how it felt to be in that position and stop doing that. But I think that's also a sign that whatever sort of sales numbers and things that we're getting in the retail sector could be really just a sort of a smokescreen, because it's maybe not real consumer money, it's credit again. So.
And some signs probably will come also from not only from Americans, from employers, from employees, but also from big companies. Earnings season is starting soon, and things looks a little bit rocky at the moment. Could it be another nightmare for the market?
Well, earnings are really, after all, what drive the stock market, right? People buy a company because they think they're going to make money, and that's the foundation of what we do. That foundation has changed a little bit. Derivative markets are really pricing equities right now, I think, more so than the equity real valuations, and that's why you're seeing all this up and down. But I think overall, I think most companies have given mixed guidance. Some have, maybe some agricultural companies or some real utility companies that necessities. And technology, I think, is always one that at this point in our lives we need it. So I mean, there are sectors that I think will probably always do all right, if not well. But I do think that a lot of companies have said, we don't know how this is going to go. Europe is a big factor. So I think that that's something that we're going to have to wait and see. Could it be a nightmare? Well, anything could be a nightmare, but it could also be better than we expect. So we're going to try to hope for that.
So we can see a good impact on the market, hopefully. Now, very briefly, 2012, you said that nothing really has changed from last week. Do you have the same sense from your clients? They are not ready to go back?
I do, I think. For the most part, that's something that I don't think is talked about enough, and that is, who is actually in this market. And I think, we've said it over and over again all of last year, there is no retail investor in this market. Institutions are using different vehicles. They're using ETFs and things that seem to be more liquid and easier to trade and faster in and out than they are. Options volume has exploded. Single stock volume, equities, U.S. listed equity volume I think it's still okay, but I don't think it's grown in the way that the ETF volume has or in the option volume has. And as I've said, I think a lot of the market action here is coming from high-frequency traders and institutions that traditionally may have had a longer-term view and now have got shorter-term strategies in place. So I think it's a very different type of market than it used to be, and hopefully we need those retail investors back. Yeah. Come back. We need them.
Let's do it. Thank you very much, Doreen Mogavero, for being with us.
Okay, you're welcome. Thank you. Appreciate it.